Hello, I'm Skip Crooker. In this video, I'm going to share with you a strategy for making wagers on the Major League Baseball playoffs. And of course, this is going to be based on data as of August 21st, 2021. So certainly we would take this with a grain of salt going into Major League Baseball playoffs, as the teams that actually make the playoffs could be different. At this point in the analysis, I'm simply treating the teams that are in the playoff picture as of now as definitely making it in. And of course, for some of our wild card teams, maybe that's not appropriate. And so again, um, this is maybe just an introduction to an idea for making playoff future bets this season. Okay, and so again, the frozen picture of the playoffs taken from this standings last night, perhaps while games were being played, and so it could have changed by this morning and even through today. But nonetheless, this is what I found when I looked. The top five seed in the American League: Tampa, Chicago, Houston, New York, and Oakland. This column, I've got the pennant price. So this is the future prices from the Westgate Sportsbook as of this morning. And then the future price for World Series. So we've got the five American League playoff teams and five National League playoff teams. Giants, one seed. In the National League, Brewers, Braves, Dodgers, and then Padres. Okay, so with the prices and playoff teams um, indicated, the next thing to think about is well, how do we know what the probability is that the White Sox beat Houston or the Yankees beat the Athletics or whatever, right? We need to be able to come up with a strategy that is going to give us a reliable estimate for the probability that that a particular team wins with a particular matchup. And so to do that, I borrowed from Bill James' Pythagorean Theorem of Baseball, which I've got the site here. If you're interested, right, baseball reference, we go in here and take a look at how we would construct this Pythagorean theorem. And notice that Bill James' original formula, right, we were taking the runs scored squared divided by runs scored squared plus runs allowed squared. This page suggests that more accurate version is to use 1.81 or 1.83 as the exponent rather than the squared. I did not do that. I just used this Bill James original version. Okay, that would give us an unconditional probability of a win. And what I suggested earlier, well, we need to have the probability, when that Houston would win, whether they're playing the Yankees, is likely to be different than Houston winning given they're playing the White Sox. And so I adopted a pseudo-Bayesian strategy to get the conditional probabilities that are going to be specific for each team playing each other opponent. And so this strategy I borrowed from Joe Peta's work, uh, a, a real interesting take that he used and described in Trading Bases, how a Wall Street trader made a fortune betting on baseball. And so again, I've got that link provided as well if you want to go in and take a look at that book, which is one of my favorite books. So certainly do recommend that highly. Also, it turns out Mr. Peta is a frequent guest on Gil Alexander's A Numbers Game. It's a very interesting podcast, daily on VZen, and here is a link to that as well if you want to check out A Numbers Game. Certainly a podcast that I think very stimulating and can give you lots of ideas. So definitely something to check out. Okay, so that's how I came up with the conditional probabilities. And then given the structure of the baseball playoffs, so for example, the wild card round, best of one, right? Four plays five, and then the winner of that meets the one seed. The 2 and 3 seeds play. Then we go, that's the divisional round. And then after the divisional round, of course, would be the pennant. And so the winner of the 1 and 4 or 5 and winner of the 2 versus 3 would meet for that pennant series. And then, of course, the winner of pennant in the American League would play their corresponding opponent from the National League. Okay, so that, of course, as we would replicate through that based on particular matchups, you could get a different opponent each time. And so certainly the structure of who is the 1 seed or who is the 4 seed definitely makes a difference in kind of the likelihood of each particular team emerging as a pennant champion or a World Series champion. So what I did with these conditional probabilities, I then simulated the structure of the playoffs 10,000 times based on these seedings. And then that, of course, is going to give me, after simulating that 10,000 times, I've got 10,000 different outcomes. I went ahead and summed these outcomes as we see here in this table. And so based on this simulation, right, my simulation finds, given the approach we've used, is the most likely World Series champion will be the Houston Astros. Houston Astros winning about 19.05% of the time for those 10,000 simulations. Of course, Houston Astros also the most likely American League pennant champion at 34%. The Giants, the 1 seed. So let's see. So Houston, by the way, is the 3 seed. So the 3 seed most likely to win in the American League, and the Giants most likely to win in the National League with a 27.2%. Defending World Series champion Dodgers and wild card presently, right? 23.52% chance to win the pennant. Okay, and then based on these odds from these simulations, I went ahead and calculated what we could describe as fair odds, or fair price, I should say, for each particular team to win the pennant, and then a fair World Series price. And so what we could do, right, so we can see, if the Westgate is offering us plus 194, well, better than plus 194, then that would be a profitable opportunity as suggested by these calculations. We take a look at Houston's actual price. The Westgate this morning was plus 300, and so certainly that does suggest we could put money on the Astros right now, and on average make money doing that. And then World Series champion as well. We see Houston Astros plus 800 this morning at the Westgate, and fair price is plus 425. So certainly profitable opportunity. Of course, there's no sure thing, right? Just because they've got a 19% chance doesn't mean that that is certainly money in the bank, but expected value would suggest it's better than a fair bet. Okay, so that's what those columns would refer to. The Yankees, you can see there must be a lot of public money on the Yankees because notice we only find the Yankees have about a 4% chance to win the pennant and a 1.5% chance to win the World Series. Nevertheless, the Yankees pennant price is plus 500 and plus 1200 to win the series, and we would need 6,394. We would need more than that to induce us, given the Yankees have about a 1.5% chance to win. So definitely we would want to stay away from that bet. Okay. Next, so given that we can simulate this 10,000 times, the next thing I do, because just knowing that this Astros bet looks like a good deal, it's not really clear how we should determine the size of our bet to make on the Astros or the Giants, or is there combinations of these bets, or maybe through a hedge, right? That we could take. Maybe we could bet maybe we could bet on something like the Giants to win their pennant, and then bet on the Astros to win the World Series, and so that way, better chance that we'll win at least one of those bets, and maybe then good potential to win both bets, right? And so kind of a hedging a hedging strategy. And so that's what we're thinking about. And to think about an optimal hedge, you took a page from Modern Portfolio Theory. So, got a link here to kind of Modern Portfolio Theory and Investment Analysis, most recent edition. Um, if you're interested to check that out, of course, we think about managing 20 assets. So we've got 10 teams in the playoffs. And so we have 10 potential assets in terms of selecting a pennant winner, and then 10 potential assets for selecting the World Series winner. So again, that's 20 assets. And the fact that we've simulated 10,000 times, we can get 10,000 realizations for the returns to each of these assets. And then also, too, it means we can calculate a variance covariance matrix for these assets. And again, you can check out my portfolio theory if you wanted to see how that variance covariance matrix would help us. But certainly what it does is it gives us a way to explore the correlation or the interaction, right? Because of how the teams might face each other in the playoffs. Um, there might be better hedges uh, than than maybe betting the team that's most likely to win, let's say. Okay, so to help us, right, I'm going to plot this efficient frontier, and the efficient, what I'm calling the efficient frontier is this black curve. And the space that we're in, right, I've got risk on the horizontal axis. And of course, we don't like risk. So we want to be as far to the left as we can. And then we've got return on the vertical axis. Of course, I want to be as high up vertically as I possibly can because that would be enjoying the greatest return. And so one here in my diagram would mean what we get from our portfolio is exactly what we invested. So if we're investing 1 unit, for example, so if we get back 1 unit, then we've made no profit. Essentially, we can subtract 1 from our return to get where our profit is. So we can also see that if I want my return to be higher, what must happen on our optimal portfolio? Well, in our optimal portfolio, to get higher return, I must accept greater risk. That is, we're moving to the right. Of course, where this black curve is really steep, I don't have to move very far horizontally to get a big growth in my return, right? But eventually this curve starts to flatten out and I have to start accepting a very high level of risk to get that incremental gain in return. And by the way, if we were just using our table above and just said, well, okay, so if Houston's the most likely champion, so let's go ahead and bet Houston to win the World Series. And of course, 81% of the time, the Astros don't win. And so 81% of the time, we have a total loss. And so that's, again, what we're thinking about when we're looking at this portfolio approach. So maybe there's a way to hedge. I can lower my risk dramatically. And I would say up here on this part of our frontier, we're lowering our risk dramatically, right? We're moving a long ways horizontally as I go down just a little bit. So I'm not giving up much return to get to eliminate that extra risk. Finance theory then, okay, so where is the best place on this diagram? And we think in terms of Sharpe ratios. Professor Sharpe was the originator or credited with deriving this or suggesting this approach. What we want to do, so I'm going to put risk-free return. So I could just leave my money in my mattress, right? And I would have every $1 I put under there is still worth $1. And what I'm going to do is I'm going to find the steepest line I can draw that's just going to touch this black frontier at one point. And that is going to be the bundle or the portfolio that gives me the highest return for the level of greatest return for that risk. You can see, so below that, I can actually continue to get more return for a little more risk. And so then this becomes that maximum return to risk ratio. And so this is the bundle then that Sharpe is suggesting that we think about. And so that's what I'm going to adopt as as our best choice. Let's see, it looks like that it's about 16%, right? So we're expecting about a 16% return on average, and our level of risk metric is this 0.2383. So that's the level of variability in our portfolio returns. Okay, so then what is that portfolio that gives us this best outcome? And it would be to make these wagers. So definitely placing many more than one or two, as you can see. So if we're betting one unit, and we should be able to sum these values here, and we would get one. So we're not taking any position on the Athletics, nor the Braves, nor the Padres. But it looks like we've got everybody else covered, right? And so we bet betting quite a bit on pennant winners, right? So about 21.5% on the Rays, 21% on the White Sox, almost 22% on those Astros, 8% on the Athletics. And here, is a danger of this approach. We do have the Athletics covered, but do keep in mind it's not a shoe-in that the Athletics are going to make the playoffs, right? So right now I would be a little bit apprehensive about covering the Athletics, given they haven't got their ticket to the postseason punched exactly yet. But that's another thing that we can explore with this strategy. So we can monitor this over time, and we can see how robust, right, changing the playoff participants, or as their Bill James Pythagorean theorem win percent, and then which certainly affects the Peta devised Pseudo-Bayesian, I'm calling it Pseudo-Bayesian conditional probabilities of winning, right? Those things are going to have changes, and certainly would cause changes in our simulation, which is likely to cause simulation in what we're thinking about as our optimal bet. But again, we can see over time, for example, in another week, we come back and measure this again and see, do we see our positions changing very dramatically, or if they're fairly robust, not changing very much to those underlying conditions, then we can have a bit more confidence, perhaps, in taking these particular bets to the window at the sportsbook. Okay, so again, it looks like quite a bit of money out here on our pennant winners, and then World Series winners. It doesn't look like as much, but remember, we also get a higher multiple, right? Those World Series prices were bigger prices for us, and so as they're plus prices, of course, meaning a much bigger return for us, the better. Okay, so this is what our analytics is suggesting as our optimal portfolio. What I decided to do here is, well, let's go ahead and test this, and so I can simulate again, right? So after getting these particular bets identified, let's simulate again. So make some new random draws and see how well those particular bets would have performed for us. And I think I did another 10,000 draws. Of course, we're expecting to see about a 16% return on average, right, based on the analysis above. So here's a histogram, and we've got the probability on the vertical axis. And so here, this is profit. So I've taken the return and subtracted the 1 for our bet. And so this green line here is showing us where that break-even point is. And so perhaps good. A lot of the time we're over here. There is some period of time where we missed, we didn't have any of the pennant or World Series winners covered. Here we didn't have the Athletics, the World Series winner. We missed the Braves and Padres, so perhaps Athletics Braves in the World Series would be really bad for us. Although we do have Athletics covered up here. Let's see, San Diego. Yeah, so maybe it's just really close to that -1. Yeah, lots of times where we could potentially not have any of the pennant winners covered or World Series winners. Of course, that would be a total loss, but the likelihood of the total loss has gone down a lot. Again, remember when I started, it suggested, well, if we just take the most likely according to the analysis, it suggested we would cover the Houston Astros. Of course, the Houston Astros were only winning 19% of the time, which meant 81% of the time we had a total loss. Here we can see total loss is much less than 81%. We can see a much higher, taller histogram bars here, and in particular to the right of 0, right? That looks like more probability mass to me than on the negative side, and so certainly meaning more likely that we're actually going to make money from the postseason, which is certainly what our objective is. In fact, we find 79% of the simulations this was true. Of course, my simulations are built on the behavior, the assumed behavior, the modeled behavior for those conditional probabilities, and we haven't demonstrated that that's going to be true, right? But nevertheless, suggesting we are profitable 79% of the time. And our average profit is actually pretty good from the simulation, right? We're making 0.84 profit. So for every 1 unit we wager, right, we win back that one plus another 84%. And so indeed, that is very good. In fact, much better than we expected. And I almost worry that maybe that happens to be 0.16 less than 1. So it may be the 16%, but maybe I subtracted twice or something. So anyway, I'll need to look at that, because certainly we would expect this to be really close to that 16%, particularly since the simulation is modeled on that same behavior that we use to construct our portfolio. For what I described as the most likely outcome, right, from our original simulation, right, we said most likely Astros to win the American League, Giants win the National League, and then have the Astros win the World Series, right? That would be the most likely outcome. And if we had the most likely outcome, right, how would our portfolio do? We would have hit on all 3 bets, but notice only about 28 cents worth. But let's see, if we look at the Houston Astros to win the pennant at the Westgate, winning the pennant for the Astros was plus 300, and so we get plus 300 plus our money back, so it's 4 times that bet amount. Our optimal bet amount for the Astros on the pennant was 0.2197, plus now our bet on the Giants to win the pennant, Giants to win the pennant, 0.0629, and then the payout when the Giants win the pennant from the sports book, from the Westgate in this case, was plus 4, so plus 400, and then of course we get our 1 unit back, so that's 5, so 5 times that bet amount. And then finally the Astros winning the World Series. Let's see, we were going to put Astros winning World Series 0.0184, and then the price for the Astros winning the series was plus 800. So plus 800 plus our 1 unit back is 9, right, times that amount. So we can multiply these things, subtract 1, and you can see we would earn a 35% return. So if our unit size is $100, we would make about $35.84. If our unit size was $1,000, we would make about $358.40. Again, this depends, right? We've made some underlying assumptions, right? We've supposed this Pythagorean theorem is a good way to approximate team performance in the playoffs. We also use Joe Peta's approach in calculating conditional probabilities to figure out likelihoods of particular teams winning in particular matchups, and then simulating. As we're doing that, right, much of the baseball statistics we use to construct those probabilities is over obviously the entire team season. And of course, we know around the trade deadline, many teams changed quality characteristics. And so certainly that would be reasons for those probabilities to change. And so it could be a problem for this approach, right? We've acted as if those things won't have any implication. And of course, the exact teams that make the playoffs still unknown at this point, and so certainly that can have an effect as well. So again, this is maybe a first step or an interesting way to take a look at or think about what might be some optimal bet positions going into the Major League Baseball playoffs. Now, with that said, I would love if anyone out there happens to have some future prices for pennant winners and World Series winners. That would be really neat because obviously I can get at all the baseball statistics historically, and so I could apply this method to see how well it does at predicting World Series winners. But it would be interesting to get those betting prices to bring that into the analysis to see if it produces profitable returns or not. And so that would be a future direction for this research. If anyone out there has any of those items, those future prices, Major League Baseball playoff teams going into postseason, that would be very interesting analysis to do. Um, and then the other thing I would say is that we have the NFL season coming up here very soon, and so I do have an analysis where we look at win totals, futures win totals, and use a very similar approach because the football schedule, right, and who you're playing, right, those conditional probabilities become very important to kind of project out win totals for each team through the end of the season, and so that I think becomes an interesting analysis. And so I've done some analytics to work up which of those over under bets one should be thinking about. And so that would be what I'm looking at could be a future direction on a podcast as well. Otherwise, if you have questions or interest in information or learning more about what I've done here, would be happy to think about or go over those things. One of the hardest things, most intensive, would be this modern portfolio theory, but we can take a few stabs at how we can describe and do that. Thanks for listening.